There's going to be a recession. It's going to be bad. Why on earth is the Fed raising rates at all?
Welcome to Craft Investing, a place where you can get news on cryptocurrency markets and global finance. Don't forget to smash the like button and subscribe to us.
The thing about labor force participation is a very simple calculation. You say how many people are working, that's the numerator, and how big is the labor force, that's the denominator. That's all it is. Now, it's never 100%, right? Because there are students and homemakers and retirees and others. There are good reasons for some people not to be in the workforce at any given time. But as recently as 2000, that number was 70%. What drove it between approximately 1975 and 2000 was basically women entering the workforce, women who had been home, as homemakers or performing other roles, entered the workforce, and then that number went up. So like I said, it's never 100, but 70 was very strong. 62 is down a lot. I mean, that's about a 14% decline. Look, GDP, the standard definition is, it's consumption plus investment plus net exports plus, government expenditure, like a four-part thing. Yeah, but there's a simpler way to do it, which is how many people are working, how productive are they? Just who's working and how productive are they? That equals nominal GDP. And if you have fewer people working, the economy is going to shrink unless productivity is going up, which it's not. And so this is one of the major headwinds. Now, you're right, there are some early retirees. There were a lot of people who stayed home, obviously, during COVID, and it's very well studied and clear that working is a habit. It's a good habit, I think, for the most part, but it's like any habit. Once you break it, it's hard to go back. So once you get used to not working or working from home or, we're just staying home, the government was handing out checks, beginning with Trump in, I believe it was June 2020. Everybody got that one was a $1,400 check. And then in December 2020, at the end of the Trump administration, everybody got a $600 check. And Biden comes in February 2021, not to be outdone, he hands out, I think, a $1,600 check. So everybody got a check, like two or three of them. And a lot of younger people opened accounts on Robinhood and started trading Bitcoin. That didn't work out too well. But a lot of people saved the money. But there were very definite spikes in retail sales coming within 30 days of the checks. Well, that's not surprising. I give people free money, they'll go buy stuff. And that kind of kept the economy going. It wasn't a real boom, but it looked good. But we're not doing that anymore. There's no more checks. And so you had a lot of people who lost the habit, a lot of people staying home, watching, maybe the World Series or whatever, eating Doritos, but they're not working. And a lot of people out of the habit, but they just got used to government handouts. Not everybody, but some. And the Fed looks at unemployment. I mean, I look at it because you're supposed to know what it is. I mean, I always say, if you're trying to forecast the Fed, you got to look at the world the way they do, even if it's messed up. Like even if they're looking at the wrong things, which they are. As an analyst, you have to look at them to figure out what they're doing. That's how you do intelligence work. Think like the other guy. But then once I take my Fed hat off and say, well, what do I think? The unemployment rate's almost irrelevant. First, that's a lagging indicator. Secondly, it ignores what we talked about with labor force participation. There is no Phillips curve. I mean, you can draw one. Last time I saw a Phillips curve was flat. Well, where I went to school, curves weren't flat. But that's but they're just looking at the wrong indicators. I don't know what the recession is a cure for. It's coming. I mean, the recession is coming, but and Jay Powell said this. I mean, Jay Powell gave two speeches, August 26th at Jackson Hole and September 21st after a press conference after the FOMC meeting that day. And the September 21st speech was almost like, well, just in case you weren't listening to me in Jackson Hole, let me tell you again what's happening. And he was in Jackson Hole. He was like Nancy Pelosi. He tore up a speech and wrote a new one, like literally the day before. Yep. It was 3 or 4 pages. It was really short. He used the word pain 3 times in one paragraph. I've been following Fed news for 45 years. I've never seen the word pain ever.
Right. That was pretty amazing.
3 times. But he basically said the same thing. But September 21st, he was even more blunt. He said, there's going to be a recession. It's going to be bad. Unemployment is going to go up. Get it straight. These things are going to happen. And that's what it's going to take to get inflation under control. But he went on and on about how inflation was job one, because the Fed has this dual mandate, which never made sense, but it's the law. I mean, Humphrey Hawkins. So the dual mandate is price stability and low unemployment. Okay. Those two things don't always go together. And sometimes you got to make trade-offs between the two. But right now, the trade-off is very easy, which is unemployment's really low. Now, I don't put much weight on it, but the Fed does. Again, put your Fed hat on. Unemployment's really low. If unemployment went from 3.5, 3.6 at the moment, if it went to 4.5, 4.9, is that the end of the world? Well, that was considered pretty low in 2013 when they were doing QE4 or whatever, QE3. Right. So they're willing to do that. And they also think the recession, if it comes, will be mild, but those two things together will get inflation under control. And by
the way, they think the mild because they think they're going to engineer a soft landing, which I'm guessing you think the probability of a soft landing is pretty low.
Close to zero. And what Powell said, he didn't say that their target is core PCE, personal consumption expenditure, price index, core meaning excluding food and energy. And everyone's like, why would you exclude food and energy? Again, I'm not here to debate it. That's what they do. So if you want to think like a Fed head, that's what they do. Okay, they want to get core PCE year over year to 2%. It just came in at 5.2, which was up from August. So September was 5.2. August was about 4.7, give or take. It just went up. I mean, it's not going down. But they're trying to get it down. Now Powell did not say, we're going to raise rates until core PC is 2%. He didn't say that. What he said was, we're going to raise rates until it's acting in a restrictive way on inflation, and inflation will come down on its own because rates will be high enough to cause that. Mm-hmm. At which point we, the Fed, will pause. And you say, well, when are you going to cut rates? He was like, the pause could be a year. So you're talking, forget this Fed pivot nonsense. I mean, you're talking 2024, if then, before they cut rates. But in the meantime, they'll probably raise at both of those. They're going to get rates up to five-ish. At that point, they probably will have achieve the goal of bringing core PCE down, but they will also have destroyed the economy in the process. It's like I remember in Vietnam, the old saying, we had to destroy the village to save it. Yeah. We have to destroy the economy to save it. This is the latest in a long string of Fed blunders since 1913. Seems to be their specialty, but that's what they're doing. They could at least pause now, or maybe even cut rates. If everything I said is correct, and obviously I think it is, or I wouldn't be saying it, but if we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield to maturity below what the Fed will give you for a phone call, I mean, all those things are happening. That's hard data. And it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. Right. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all?